simple moving average, exponential moving average, and Hall moving average. Three of them with the same length of look-back period, but you can see that how the Hall moving average minimizes the lag of the other two moving averages, but still it keeps the smoothness of the moving average line. Developed by Alan Hall in 2005, the Hall moving average traces and responds to price action very closely and greatly reduces the lag. In the calculation of Hall moving average, two different weighted moving averages of the price are used, and again a third weighted moving average to smooth the raw moving average. This process reduces the lag by placing weight on more recent values, and this multi-layer focus on recent values results in a very smooth moving average line that responds to the price action very closely. If you are curious on the exact formula and calculation of the Hall moving average, or you need it for any purpose, just simply search in the Google and you'll find it in many websites. Alright, now let's see how we can use it for trading. Hall moving average can be interpreted and used like other kinds of moving averages, but here the Hall moving average responds to price changes more quickly, which makes it ideal for spotting changes in trend, especially in shorter time periods for entry points. The number of periods that we choose for the Hall moving average has a direct role on how much lag there's gonna be. Generally, longer moving averages have more lags. I mean, when the number of periods in moving average increases, we encounter more lags. For example, as you can see on this chart, a Hall moving average with number of periods 10 moves very closely to the price and very quickly react to the changes in the direction of the price and turn quickly when the price turns. But a Hall moving average with number of periods 100 moves very slowly and far from the price because a lot of past prices are included in the moving average. That makes it move slowly and react to price turning very late. Choosing the right number of periods for moving average depends on what kinds of a trader you are. Short-term traders use short moving averages for trading and identifying trends, choosing the number of periods usually between 5 to 20. 5 is very fast and mostly used in conjunction by longer moving averages as a trading trigger. 10 is very popular among short-term traders, and 20 is usually the last choice for short-term traders. Periods longer than 20 is considered primary level for short-term traders and suitable for mid-term trading. Mid-term traders for trading and identifying medium-term trends usually choose periods between 20 to 60, with the 50 moving average being the most popular one, and long-term traders and investors go with moving averages with 100 and more number of periods, and in this category 200 moving average is very popular among long-term traders and investors. Please pay attention that besides choosing lower or higher length of moving average based on your trading style, the time frame of the chart must also be chosen based on your trading style, and for better results you must conduct multiple time frame analysis. I have a complete guide to this and I recommend you to watch it later because it's very important to learn how to work with different time frames. We can use the Hall moving average for buying or selling signals simply when it's crossed. When the price moves above the moving average line, this is considered bullish, and when the price moves below the moving average line, it's considered bearish. But this generates many false signals, especially when the market is flat, and a better and safer way to trade based on price crossovers is to have also a longer moving average that shows us what the overall trend is, so we trade in the direction of the market. The price crossovers that are bullish are confirmed in this strategy only when the price is already above the longer moving average, like this chart where the price is above the longer moving average line, which shows that the direction of the market is up. So only when the price crosses above this shorter moving average line, it's confirmed as valid. And the price crossovers that are bearish are confirmed only when the price is below the longer moving average line. By doing this, we make sure that we are trading in the direction of the market. We can also use two Hall moving averages to have buying or selling signals based on their crossovers, which is called double crossover. Like previous example, one is shorter and the other is longer. When the shorter moving average crosses above the longer moving average, it's a bullish signal, it's a buying signal actually, and when the shorter moving average crosses below the longer moving average, it's a bearish crossover, it's a selling signal. And also 3 Hall moving averages can be used for crossover signals, and we call it triple crossover. In this method, we have buying or selling signals when the shortest moving average crosses the other two moving averages. The buying and selling signals generated by double and triple crossovers are relatively late, and one important point that you must pay attention is that generally in crossovers we can have false signals a lot, and these methods work well when we are in a strong trend. And like any other tools in technical analysis, you should never take your trading decisions only based on whole moving average, and you must use this indicator in conjunction with other tools and concepts of technical analysis. Alright, that's it. Thank you for watching this video. If you have any questions, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you found any value in this video, please like it. Please subscribe to my channel if you haven't already, and hit the bell so you get the notifications of my new videos. See you guys in next video, and good luck with your trading.